Hi, everybody. Welcome to this week's Everhome weekly broadcast on real estate trends. My name is Lee Honish. We bring this show to you each and every week. It is a real estate trend show, just like the title imparts. We talk about what's going on in real estate that will be helpful to homeowners, buyers, sellers, and of course, to real estate professionals throughout the world. I am joined, as always, by broker owner David Bartels.
Hello.
We are sponsored by Everhome, and we'd appreciate it if you visit our sponsor. And now here's a word from our sponsor. List your home online for one low set fee. Experience the Everhome way and discover the benefits risk-free. Explore Everhome's easy-to-use listing service risk-free and begin your journey to sell your home like a realtor. Get the benefits of massive exposure, full-service representation for critical elements of negotiations, legal forms, escrow, and title for a low set fee that saves you thousands. Visit everhome.io. That's www.everhome.io. That's Everhome for every home. Welcome back. Take the time, go to everhome.io. Learn to list your home just like a realtor for one low set fee. Learn about the Everhome way. How are you today, David?
I'm doing just fine. I am excited and nervous that I'm getting my second COVID shot today.
Whoa.
I'm eager to get it done, but the side effects are a coin flip.
They are. From what I've been told by everybody, I'm a week away from mine, and from what I can tell, yeah.
So I have planned a light schedule for tomorrow, and hopefully I'll just get extra work done, and otherwise I won't have any pressure to work on it if I don't feel well.
Well, hopefully it goes well. I'm a week away from that shot, and I am a little terrified based on all the reports, but I didn't have any of the first side effects. I had a flu shot as well. I've been shot full of everything. So Bill Gates can clearly track me around the country now, and I'm very excited about that. I'm hoping I show up on Google Maps or something based on everything. Everybody take the time, first and foremost, go to social media at Everhome.io, Everhome.io on all social media platforms. Follow David Bartels at David Bartels and follow me at Lee Honish Marketing. We are here for you, and we'd like to hear your feedbacks, comments, questions, possibly even concerns. Maybe you want more of something. We're here to please. We do 2 stories each and every week. They come out. There's podcasts, there's videos, there's all kinds of stuff. Just check us out, Everhome.io. or David Bartels or at Lee Honish Marketing, and check them all out. This week, we dive, as always, into Inman First, and we start with the housing market is headed for a slowdown. Dun, dun, dun. From Fannie and Freddie. Rising mortgage rates, right? So this is looming and around the corner, David. First and foremost, for the non-initiated, as they say, who are Freddie and Fannie, and why are our aunts telling us what to do?
They Fannie and Freddie are government controlled entities. They basically run the secondary market. So, and they make sure that there's liquidity in the mortgage market. So when you go to your local bank or credit union or even a mortgage broker and you get a loan, chances are within 90 days they are going to sell it into the secondary market, which is run, where investors buy those mortgages. And that's why your original mortgage company ends up being somebody different after 90 days. And they basically control and regulate that marketplace to make sure that there's plenty of liquidity in the marketplace in order to issue more loans. Was that complicated?
No, it's better than it's my aunt and uncle telling me what to do.
It's kind of the same thing, because they do provide oversight, and they're the ones that set the guidelines for loan approvals. So it's the Freddie, and when an underwriter is looking at your loan, they're looking at Freddie and Fannie underwriting guidelines to make sure it fits in that box, because if it doesn't, Fannie won't buy that loan, and that means that lender loses the liquidity. That's why they're so particular about checking all the boxes.
I've always thought the most interesting thing about my crazy aunt and uncle, Freddie and Fannie, is the fact that they're a private company, which most people don't get. They think that they're actually a government company while they're government regulated. And then secondly, as a private company, they're usually their chiefs are usually appointed with the help of the government or their government pass downs in some kind of. So there
Yeah.
is definitely a symbiotic relationship. Seems a
Yeah.
little inbred to
Well,
me.
they are public and private, right? So the CEO or chairman of Freddie and Fannie are actually chosen by the government to give you
Right.
some, idea. So, but but they trade publicly as well. So I don't know.
I don't know how it's like the
They're
Fed. How does it work?
they're
It's magic.
they're partners with the U.S. government. Let's call it that way.
That's much like the Fed, which I'm sure someday you and I will do a whole Fed show where we go. I don't know. They print money. I can tell you how it expands.
We'll
But
need my wife for that show because she's smarter than I am.
so they're focusing on the rising rates that are right around the corner. So let's talk about this. We haven't actually seen movement in the mortgage market, and they're obviously projecting that it's going to happen. From your seat, interest rates have to go up, right? They can't keep them here forever.
They did go up. They ran up. They for a while they were under 3, and then they started creeping up above 3, and then a week or 3 ago, I'm not sure exactly when, they were hovering in the 3.5% range, and then all of a sudden in the last week or two, they have dropped down near 3% again. So they go up and down based on a lot of things. So investors, if they're looking for safety, they have a tendency to invest in those in 10-year bonds, basically, which is what drives the mortgage rates, 10-year treasuries. And when more people are investing in those, rates have a tendency to go down. And when people are not investing in those, say they're investing in the stock market instead, their rates have a tendency to go up. And the reason for that is that they want to give an attractive investment alternative. So if the more money that's going into bonds, the lower the interest rates. If money starts moving out of bonds and into, say, the stock market or other investments, then the interest rates go up. So that's why it ebbs and flows day to day, week to week.
As the economy improves, home buyer demand remains very strong. Let's talk about that point of topic. Any slowdown in the craziness throughout California right now?
It seems there are some signs that it's starting to settle down. Okay, but it's still crazy. All right, so we are. I think that the sales data that we're going to be looking at is going to eventually show that there was a slowdown, even though it doesn't feel that much of a slowdown. Right now, we're still seeing a lot of listings. We're still seeing a lot of activity in those listings. There are generally two kinds of listings out there. The listings that sell right away with a lot of multiple offers, those are properly priced. And then the ones that don't get multiple offers, and the difference is they're not properly priced. In other words, they may be priced what the seller thinks they should get for their property based on all the data that they've gathered, maybe the money they need to get for the property, but the market does not agree, and they just let it languish out there until it's either removed from the market as unsold or the seller drops the price into a range. And there's a lot of sensitivity to price. And I can give stories about that, but price is still differentiate whether or not a house is going to get 5 offers versus no offers.
So the biggest news that they put out is about mortgage origination. They originally predicted for this year 4.5 trillion, and now they've downgraded it to about 4 trillion. All right, we're halfway through this year, and I am generally a doom and gloom guy when we record. I don't predict that at all. Maybe, and they're going to talk about these points of the interest rate going up and refinances instead of repurchasing because people don't have options. But let's just talk about dropping their projection by, if I'm right, 500 billion as we talk in these etherical terms, because I don't even know what a trillion is. So is that seem realistic? Or I feel that it's on pace to be certainly what it was last year, if not greater.
Well, the big difference here is that there are two mortgage markets, right? There's the purchase market and there's the refi market. The purchase market is stronger than last year, but the refi market is way down. And that's really where you're seeing the pullback. You're not seeing it in the home purchase category as much. As there might be there's an uptick there, but you did see the refinances pull way back, and that's where you're seeing the adjustment in the estimates.
There you go. Fannie Mae stated that while housing demands remain strong, these are certainly indicators that they're looking at because of all these effects. But given the continued supply and demand issues, they came out with this very strange twist in the whole thing, which is very encouraging. They originally forecasted a 4.2% increase. Now they're saying an 8% increase. And I think that's I think they're underbidding this based on where we're going. House percentages increasing nationally, I think might go as high as 10%. I think it's really on a strong pace at this moment.
Well, it has been. If you go back a year from today, you'll see house prices, depending on the report you look at, have appreciated in the 14-15% range. So you see 12%, you see 14, 15, some 16. So let's call it 15% range. And so what they're seeing is simply a pullback in the rate of appreciation. The number one thing that's driving that decrease in the rate of appreciation has to do with affordability and availability. So number one is that there are a lot of people who are priced out of the market that would be willing to pay more for a property if the bank would let them. Okay, if the bank would lend them more money. And then the other thing is that there's increased availability, and so sellers are having to compete with other sellers a little bit more than they had to, where they were really the only game in town, and there was no other homes to choose from. They were able to command, a massive premium in the price. So you're just seeing this is the best sign that you're seeing a slowdown. It doesn't mean that we're going to sell fewer houses, but what it does mean is that the markets are kind of stabilizing as demand, where supply basically is increasing, and the buyer demand is absorbing that inventory at a less rapid pace. And I would think that by next year, we should be a lot more normalized, and you'll see housing prices grow somewhere in the range similar to the rate of inflation as the market really stabilizes.
Fair enough. Fannie's / Freddie's final opinion on the whole matter was that they actually see a continued growth in the GDP. And most of this, much like you've talked about a few weeks ago, which is important to note, David talked about this first.
Well, I don't know about
virus
first,
restrictions lifting, right? And that it will stimulate. Here's the whole thing about this article, David, as I put it together, as I read it for the first time, and what's so interesting to me. The title of this article is "Housing Market is Headed for a Slowdown," says Freddie and Fannie, which to an uninitiated person who doesn't know much about them, a consumer or a real estate agent, this is a gloom and doom looking article, when in fact they're just going, we're just adjusting our numbers. That's all we're doing here. We're not really seeing anything. It's still going to be a long, hot, crazy summer of insanity. In fact, we're going to change our projections and tell you prices are going to go up. We're just adjusting the volume because we're just running out of inventory and things are changing. But the economy is strong. The gross domestic product's going to be stronger. Like, everything about this is kind of a positive piece about where it's all going. It's not, yes, the sky is falling. I'm just wondering how. I get it because I do this for marketing as well. The housing market is headed for a slowdown is a much better article than generally everything's okay. Take a deep breath and enjoy the ride.
Well, slowdown in this case means busy. Okay. Right. I mean, it's just been unreal. You can't sustain 10, 15% year over year appreciation numbers. I mean, think about that. A $100,000 house, that makes at a 10% appreciation makes it worth 110 next year, and then 121 the next year, and then the compounding on that makes it really unaffordable. And when you apply that to a to a $500,000 house, you're saying this year is worth 500, next year is worth 550, 575, and then the next year it's worth 625, 630. It can't do that. A normal rate of price appreciation is 3% or so. Okay? And that is really what you expect it to be. And this year we had an inventory imbalance as a result of COVID, and that is starting to loosen up, and that's why you're seeing the pullback, as you will. 8% growth this year is still too much. You really wanted to see 3%, 4%, and that's a healthier market.
There you go. Everybody, check out a word from our sponsor, Everhome. List your home online for one low set fee. Experience the Everhome way and discover the benefits risk-free. Explore Everhome's easy-to-use listing service risk-free and begin your journey to sell your home like a realtor. Get the benefits of massive exposure, full-service representation for critical elements of negotiations, legal forms, escrow, and title for a low set fee that saves you thousands. Visit everhome.io. That's www.everhome.io. That's Everhome for every home. Welcome back. Please visit Everhome, everhome.io, and also on social media at everhome.io. I agree with you, David. I think we're growing too fast. And what I think kind of the point of this article subversively or the underlying theme to it is we correct, right? So if it keeps jacking itself up and you guys get used to that, this thing's going to come back down. This is a long, continuous roller coaster ride with ebbs and flows. The real estate market always goes up. It always comes down. The GDP always goes up. It always comes down. I don't want to say this to everybody who's complaining about Biden and gas prices right now. Prices go up. Guess what? They're going to come down. Is there anything to worry about, or is this just the state of doing business?
I think that I don't think there's that much to worry about. Listen, if you really want to know what the consumer confidence is, which is really the driver of GDP and the economy in general, okay? Is consumer confidence, all you have to do is look at the stock market and look at the gains it's made during this past year. I mean, it's look at real estate. There are a lot, and then you look at all the stimulus money that's been put out there, in the world. There are people out there that are sitting on mounds of cash and nowhere to spend it. I mean, I was looking at my bank accounts yesterday, and I was surprised how they've swelled, in the last year. Not because I'm making more money, because I'm not spending any. I'm not doing anything. So and so all of a sudden I'm seeing my balances are starting to accumulate, which the truth is made me want to go spend some money. It's making me think, well, maybe I should do this and maybe I should do that. And that's the kind of thinking. And there are a lot of people like that, and they're wanting to go out and spend some of that money, which is going to drive GDP growth.
I would even go a step further because I have personal experience with it these days. Even if you're a startup and you're building a corporation or a company or an LLC, which you should, there's a lot of money out there. People are trying to get money onto the market. You have to look for it. It's not easy to find, especially for first-time people in certain fields. But the money's out there. People are ready to push it, and they're ready to spend on the economy. Is there any advice you can give to real estate agents that still continue with the I'm struggling, I can't get a grip on the market?
Yeah, activity equals productivity. Go out and talk to people. And, don't be a secret agent, let people know that you're, that you're there, you're able, you're competent, and you're ready to work hard to help them achieve their needs. It's not, there's no mystery to it. You just go out there and do what you do, help people, find out what people want and help them get it.
There you go. Simple as that. Follow him at David Bartels on social media. Follow me on social media at Lee Honish. And of course, go visit our sponsor, everhome.io, or on social media, everhome.io, on all forms of platforms. You can find us on video if you're listening to the audio. If you're watching the video, you can get us on audio. Look at how that works. Click like, subscribe, share it with a friend. And my favorite thing to say at the end of everything I broadcast these days, smash the like button. I was doing one of my shows on the weekend with the guys talking sports, and I have a younger member on it, and I said, am I getting it right, Miguel? And he goes, yes, they all say smash the like button. I said, all right, I'm just checking. I don't, I'm a middle age. I'm saying middle age, probably older than that.
I think you're officially a hipster now.
I am officially a hipster now. Please go do that. We will be back later on in the week with more for you.